Amazon looks like a dominant, unstoppable business. Revenue is growing, AWS is accelerating, and margins are improving. But at the same time, the company is about to spend around $200 billion in a single year. This matters because the entire investment case now depends on whether that spending actually turns into durable profit growth. Amazon is still delivering strong operating performance. Revenue reached over $213 billion in a recent quarter, growing around 14% year over year, while operating margins improved to roughly 11.7%. AWS alone is now running at about a $142 billion annual revenue pace, with growth accelerating into the mid-20% range. This matters because AWS is the profit engine. It represents less than 20% of revenue, but generates the majority of operating income. At the same time, advertising is quietly becoming another high-margin driver, likely exceeding 30% operating margins. Retail, which still makes up about 74% of revenue, is lower margin, but continues to scale. This changes the story because Amazon is no longer just a retail company. It's a margin expansion story driven by AWS and ads layered on top of a massive distribution network. The stock trades around $240, while fair value is estimated at $260, meaning the market is pricing Amazon at roughly 0.96 times fair value. That's basically fair with slight upside. This matters because you are not buying a deep discount. You are paying for execution. On a multiple basis, Amazon trades at around 35 times forward earnings and about 3 to 3.5 times sales. That might look expensive, but the key detail is cash flow. Free cash flow actually turns negative in 2026 due to heavy investment, before recovering strongly later in the decade. This changes the story because valuation is not about current earnings. It's about whether future margins expand enough to justify today's spending. The key shift is aggressive reinvestment into AI and infrastructure. Amazon plans around $200 billion in capital expenditures, mostly for AWS capacity and AI workloads. This matters because the company is deliberately suppressing near-term cash flow to secure long-term dominance in cloud and AI. On top of that, Amazon is expanding into satellite connectivity with an $11.6 billion acquisition of Globalstar at roughly 40 times forward revenue. This changes the story because Amazon is extending beyond cloud into infrastructure layers like connectivity, but it's doing so at very high cost and uncertain returns. In cloud, Amazon competes directly with Microsoft, which is currently trading at a much larger discount to fair value, around 0.66 times. This matters because the market may see Microsoft as the more attractive AI bet right now. In retail, Walmart is pushing aggressively online, while eBay is losing relevance but still competes in marketplace dynamics. The biggest risk is not demand, it's capital intensity. Amazon is spending so aggressively that free cash flow turns negative in the near term. This matters because if AI demand slows or returns disappoint, the entire investment cycle becomes a drag instead of a moat. Regulatory pressure and international expansion risks add another layer. But capital allocation is the core issue. If AWS continues growing around 19% annually and advertising around 21%, margins expand from roughly 11% to 13% over time. This matters because even small margin improvements at Amazon's scale translate into massive profit growth. If that plays out, today's valuation looks reasonable and potentially cheap in hindsight. Amazon is no longer a simple growth story. It's a capital allocation bet. The business is strong, demand is real, and the moat is intact. But the outcome depends on whether massive AI spending converts into durable, high-margin growth. At current prices, the market is assuming it will, but not giving you much margin for error. I'll break down the next one soon. Subscribe if you want to stay ahead.